I want to thank everyone here. I know this is about the best way you can spend a Friday talking about bonds. I will promise that we will get you out of here on time. This course, we're going to start very, very basic with the basics of bonds, and then we'll move to slightly more complex issues associated with them. You can ask questions at any time. It'll break it up and make it more interesting if you do ask questions. So just raise your hand or yell at me if I don't see you. So we'll start here with what a bond is. And basically a bond is somebody loans you money and you agree to pay them back X amount of dollars on a certain date at a certain interest rate. Throughout this speech I'll probably say the word municipal bond, and it's not a slight against the counties saying municipal or municipality. It's just a jargon, a term of the industry that we'll use the word municipal bonds or muni bonds to refer to not only municipality bonds but county bonds, even bonds issued by 501c3 tax-exempt organizations. Counties and cities obviously issue bonds when they need to raise money. So a bond is just like any other kind of promissory note where you borrow money. It's like mortgage loans or car loans, installment loans, corporate bonds, U.S. Treasury bonds. Bonds work the same way. There's slight differences in that your mortgage loans, you'll pay back your principal and your interest on a monthly basis. And the same with a lot of these other type of loans. Municipal bonds, when you borrow the money, you'll pay the interest back. As a general rule, you'll pay the principal back once a year. You'll make a principal payment. And twice a year, you'll make an interest payment. So what makes municipal bonds different from all other types of bonds and promissory notes? Well, they're tax exempt. Just like any other type of loan, the lenders will earn interest income. Lenders pay income tax on their interest earned from all the other types of loans, mortgage loans, car loans, installment loans, so forth, even other types of bonds. But with your county bonds, when you issue bonds, most of the time the lender will not pay any income tax on the interest that it earns from your bonds. The reason that they accept, since they don't have to pay interest on your bonds, they get a lower interest rate. So how does a county bond become tax exempt? Well, first of all, the reason that they're tax exempt, it's not because the federal government's been kind enough to say all municipal and county bonds won't have to pay interest. It stems from an 1895 Supreme Court decision where the federal government tried to tax the interest of the bondholders, and the Supreme Court held that they could not. That decision was eventually overturned. However, in the 1913 Revenue Act that gave us the income tax that we have now system, it was codified in Section 103 that municipal interest or interest on municipal bonds will not be taxed. Now, it's not just simple enough that you, as a county, issue bonds to become tax exempt. There's hoops that you have to jump through. The first is that you have to get an opinion of a bond attorney or bond counsel who will say a couple of things in his opinion. One, he'll say that it's a valid pledge and it's been issued in accordance with applicable state law. They will also issue an opinion that says it is tax exempt. Now, in order to give that opinion, they're going to be, your county attorney will, or your finance team that's working with the bond counsel will answer a series of questions, and one of them is, what are you going to do with these revenues? Because you're borrowing the money at such a low rate, the federal government has gotten wise because municipalities used to borrow money at a lower rate. It could invest it at a higher rate and make returns off of that. Well, the federal government woke up and decided that, well, there's going to be some rules. And these are called the arbitrage rules, that you can't borrow the money cheaply, turn around and invest it and make a profit. So in order to do that, there's a couple of things they've done. One is that you have to rebate any kind of excess earnings back to the federal government. The second is, in order to issue the bonds, the bond attorney will have to come to some conclusions on how you're going to spend the money. And one is that they have to have a reasonable expectation that you're going to use 85% of the funds within 3 years. Also that you're going to spend a portion of the funds on capital cost, or if you're going to refinance an outstanding debt, for a lower interest rate. So they have to come to a few conclusions. In 1986, the rules changed greatly with the Tax Reform Act. Municipalities used to be able to issue all the bonds they wanted, turn around, loan the money to various types of private entities, and that loophole has been greatly reduced. You now have only so much of money that you can use in certain situations to loan to private industries. No longer can you just borrow money through tax-exempt bonds, loan it out to have a bunch of McDonald's in your area. And second, I guess my last on this slide, although most bonds are tax-exempt, not all bonds are tax-exempt. There's a couple of times where your county will issue taxable bonds. One is if it's issuing tax-exempt bonds and it decides at the same time, because of the limitations on what you can use proceeds for, they'll decide that we need to borrow an additional amount of money, but we'll go ahead and pay a higher interest rate and issue taxable bonds. So sometimes when you issue bonds, you'll see that there's two different series of bonds. One's tax-exempt, one's taxable. The second is every now and then we have a new kind of bond that'll come out. In 2008, after the Great Recession, we came out with Build America bonds. President Obama signed that into law at right at 2009. So in 2009, 2010, we issued a bunch of Build American bonds. How these worked is that the purchasers of the bonds would get a higher rate of interest and would pay taxes on it. In return, the federal government would agree to rebate a certain percentage of money back to the municipality directly. This did two things. One, it allowed, if you look at the tax exemptions from U.S. income tax, the purchasers of your county bonds that are tax exempt are going to be people subject or institutions subject to the federal income tax or state income tax in other states. When the Build America bonds were issued, it allowed taxable bonds to be issued, which meant that the potential buyers of the bonds would get a higher rate of interest, and now all of a sudden foreign countries, China, would be directly buying municipal debt in addition to buying federally issued debt. This went on for a couple of years, and it had two effects that we're learning now in a couple of cases. One is quite simply that in the past, if a county issued tax-exempt bonds, you didn't follow the rules, and it was declared later by the IRS to be taxable, the people that paid the price are the bondholders, because they're holding your bonds at a lower interest rate, and all of a sudden they have to include all of that income in their income tax. So the municipalities aren't hurt, except for the fact that when the counties go back to the market later on, everyone looks at you and realizes you issued bad bonds before. You're going to pay a higher interest rate now because there's more of a risk associated with your municipality. The second effect is that when you issue the bonds, the taxable bonds, and there's talk right now of creating a new kind of bond. President Obama has actually put a budget out that's going to include America Fast Forward bonds. These would work just as the Build America bonds did for a couple of years. You would get pay a higher interest on your bonds, but you will get a subsidy back from the federal government. There's two issues with this. One is that the federal government can turn around and take away your subsidy if you are not complying with your obligations and or your bonds were issued badly. The second is when we're seeing the effects of sequestration now, is that in certain instances, the federal government may not have money to rebate back to you. So when someone makes a loan, they always want some sort of security. With your mortgage at home, it's the real estate that they'll foreclose on. With a car loan, they'll repossess your car. With municipal bonds or county bonds, it's going to be a revenue stream in most cases. The vast majority of municipal bonds, there's going to be some direct pledge by the county to the bondholders that the bondholders can seize if you don't pay back your principal and interest payments. In this slide here, we've got a list of the typical projects that a county would undertake and the typical revenue stream that you would pledge as security for the bonds that you issued. Some are very simple, obviously, with water and sewer projects, would be water and sewer revenues. Stormwater systems, there's a variety of different types of revenues that can be pledged, stormwater assessments, part of your sales tax, your utility tax. When we speak of general fund non-ad valorem revenues, in that situation we're actually talking about what we call a covenant to budget and appropriate. And these are not actually a direct pledge of revenue. What they are is the county saying we agree that we will covenant any legally available non-property taxes in support of doing this. So it's a promise from the county. Prior to the Great Recession of a couple of years ago, the vast majority, a lot of the bonds we did would have a covenant budget to appropriate. It was considered the closest thing to a general obligation bond. Now lenders sometimes will take this in addition to, depending on the county, in addition to direct revenue pledges. With roads and transportation, a lot of times we'll use gas tax and tolls. Obviously for expressway authorities and that sort of thing, the tolls are almost always the revenue pledge. Landfills and waste incinerators that a county will issue money or need to build capital projects for. They'll use a solid waste tipping fee and assessments. And I'm not going into the revenue stream in detail. It's my understanding that Ginger, I guess, spoke to you all this morning about county revenue sources. But the solid waste tipping fees are normally called the gate fee. And the idea with the gate fee is it's priced to pay for not only opening the facility, eventually decommissioning the facility and running the facility. Then when we get to the municipal service taxing unit and the municipal service benefit unit and further down, these are special funding mechanisms that through the approval of a board of county commissioners can allow specific taxing districts to be put in place in specific neighborhoods or communities. These are, the difference between the two is the municipal service taxing unit is funded through a millage, which is essentially a property tax, and the benefit unit is normally a special assessment, but it would still be collected on the property bill. Just so y'all know, going forward, the Florida Supreme Court has held that a special assessment is not a tax, so you can always tell your constituents that. I'm sure they'll believe that one. And I can give you the case law site, but it's not going to do you a whole lot of good there. That was City of Boca Raton versus Florida in 1992. And special assessments, when we create these taxing units or special units, they're normally to fund landscape, beautification, streets, sidewalks, lighting, stormwater management, those type of projects in a certain area. Sometimes you'll see, rather than the county institute the process through one of these, we have, a lot of us have CDDs or community development districts. Those are actually municipalities. They're normally created by developers, and they will issue special assessments that will work the same way, go on the tax bill, and allows them to construct improvements now by borrowing money from various types of lenders in the capital markets.
How is this different from CRAs,
community redevelopment agencies? Yeah, that's a CDD or community development district is normally created by one or the landowners have to agree to be bound. So one of the landowners will decide to create it. Normally it's a developer or a very small group of developers that own a large land that's undeveloped somewhere. The community redevelopment agency, the CRAs, tend to be government will use them to find a blighted area. And it's we call it tax increment financing is the technique. And they, the way these work is a lot of times you have to find, you have to make a finding of blight. Once the government makes a declaration of blight, they then will come up with a pledge of the increase in tax revenues by putting money into an area. So the idea being that you borrow a bunch of money, you put it into an area to redevelop it. Because of how much money you put into it, it increases the tax base in that area. And couple years down the road, there'll be an increase in tax revenues in that area. And that money, the difference between what the property taxes were and what they are now, will be a direct pledge to repay the bonds that you borrowed the money to. CDDs are a way that the Florida legislature, normally counties roll in it, well, it depends on the size of it. No, that's fine. It's more of a development driven creature for raw land. Most of the time we see them. Rather than a county coming together and saying, okay, we have an area we want to improve, it is a developer saying, this is an area I want to create a development. And in order to build the infrastructure, I need to borrow money. So they create a CDD, which is a government or municipality under Florida law. Excuse me? Yeah, and that's it's a similar organization. We don't get too involved in bonding with those, so I apologize, not too familiar with their rules.
You mentioned tax increment financing. Is that another term for CRA, or is that a...
They're almost always 30 years. They can be anywhere from 15 to 30 years, but they're long-term borrowings. So the tax increment financing, most of the time the lenders will realize we're not going to get a lot of money back for the first couple of years because it's going to be a ramp up in the revenues as the redevelopment creates a better property base.
So with the tax increment financing, is that my understanding that involves borrowing or bonding money with it, whereas CRA would not? You could just collect the appreciation over time?
My role, that's a great question. My role is always when we're bonding. So when I'm involved, we've actually borrowed money for the project and gone from there. But the roles of the Community Redevelopment Agency, it's set forth in Florida statute, and it's probably a great question to run by your county attorney. So. When I mentioned that most bonds are revenue stream pledges, the exception is general obligation bonds. There's not a pledge of revenue, it's a pledge of your taxing power. You basically agree that you will raise your taxes to the point necessary to pay back the bonds. In order to do it, the Florida Constitution mandates that you have voter approval unless you are refunding existing general obligation bonds and you meet a certain savings requirement. So hence, these are not as popular because you do have to get voter approval. So they're rarely used. I would estimate 1% of all bond issuances involve them. And even though it's a pledge of the unlimited taxing power, and you should always view it that way, there's an interesting line of Supreme Court cases, and in fact, if you look at municipal bankruptcies throughout the country, that at the end of the day, will they enforce that covenant to raise taxes to the point of repaying the bondholders? Because obviously at some point you're putting an incredible burden on the people that live there and you're destroying your tax base because people start to relocate. So the question is, why do you bond? There's two approaches to all government improvements, or large-scale improvements. One is that you pay as you go, and one is that you pay as you use. Pay as you go is the idea that you save up your money and then you pay for your capital projects. The pay as you use is the bonding approach. When you pay as you go, the construction is only done once the funds are available, whereas pay as you use, you borrow the money through bonds, you go ahead and undertake your construction now. When you pay as you go, today's citizens are going to bear 100% of the cost. They're going to have to pay for the entire project now, whereas when you bond, you have a 30-year repayment schedule. Anybody that moves into your municipality or your county within those 30 years is going to be paying part of the taxes or service fees or whatever the pledge is to pay for part of the cost. Pay as you go means long waits. You have to wait until you have the money. If you bond, it's a more rapid response to public needs. The lower total cost in the sense that you don't have to pay interest if you don't bond. If you bond, you have to pay interest. So there is a cost associated with bonding, being your interest cost. But that sometimes can be offset with the fact that if you wait until you have the money, project costs can escalate greatly. You figure the rates of inflation, whereas if you pay for the project now, your costs are fixed. So when you get involved in a working group transaction for a bond deal, there's a lot of different parties, and you'll hear a lot of these names, and so we'll give you a quick rundown of who they are. The issuer, in most cases, is going to be the county. in your deal. You'll a lot of times have your own attorney, either inside counsel or outside counsel. Most of the time, counties will have an assistant county attorney or a county attorney involved. Then you'll have a financial advisor. There's a couple of national firms that do do nothing but advise municipalities and counties. And then there's a whole host of regional and local firms that do this as well. Their role and how active and important they are will depend also on whether or not you're doing a competitive underwriting or a negotiated underwriting, which we'll talk about in a minute. Then there's bond counsel. Bond counsel in a bond deal is the most important group of lawyers. They issue the opinion that the bonds are tax exempt. They issue the opinion that the bonds are valid. They put together the indenture, which is the document that the county binds the county to the trustee, which is normally a national bank, U.S. Bank, Wachovia, and the trustees representing the bondholders. So the bond counsel will also print the actual physical bond, which will be when you get to a closing table, which will be the green document. You always see them printed on green paper. And then we have disclosure counsel. There's different types of bond deals. Sometimes it's a local bank that's buying your debt. Sometimes it's just a couple of buyers. With counties that are issuing large bonds, you're going straight to the capital markets, which are the New York markets.
I just have to ask, this is a Friday afternoon question, I know. We just had a lot of competition in our county over hiring bond counsel.
Uh-huh.
We had 3 firms, and, one I just talked to at our reception the other day, was still angry because we didn't pick his firm. Is there just tons of money for the bond counsel in this? I don't exactly understand, you say you put together the documents and stuff, but what do you look for in bond counsel that makes it such a coveted job as a vendor for the county?
Well, there's definitely
Yeah.
I make my living on responding to RFPs, but it's.
The hottest thing, hotter than the feral cats issue, which is big.
Right.
Just wondering.
It's like any other work that's bid out. There's several different. There's going to be competition, and there's several different roles in the transaction. And if you make your living responding to these, it's a big deal if you win or lose.
That's a kind of vague answer if you ask me.
That's the toughest question I've had in a while. All right, so we have a couple of different roles. Disclosure counsel is only involved when you are accessing the capital markets. And what disclosure counsel does is they can be actually representing your county, which is, in most attorneys' opinions that are in this world, the best way you can go is actually hire your own disclosure counsel. And I'll give it in a nutshell. Here's why. They prepare the document that describes not only the terms of the bond transaction, but all the risk. So it tells the people in New York that are buying your bonds, the underwriters, the investment banks, Wall Street, it tells them these are the risks of buying our bonds. We learned a couple of years ago in the Great Recession that a lot of good businesses and well-run businesses were filing for bankruptcy. Municipalities are not immune to this. And what the Disclosure Council does is they prepare the document that when you get sued because you don't pay back your funds, if you default. Now, municipal defaults are very rare. I mean, it's a percent of a percent, 1%. It's very, very small. But when they do, there's a lot that happens. The underwriters bring lawsuits. There's federal regulatory organizations such as the Securities and Exchange Commission that get involved. And I guess this is the whole reason why, it's happened to the city of San Diego not too long ago, where their officials involved in the bond transaction personally were fined. Now, this isn't your county being fined. This is you writing a check for $5,000 to $25,000 because your disclosures were bad, your practices in issuing bonds were bad. I don't offhand can't think of another case. I haven't looked at the case all in a while where individuals actually got fined or settled with the SEC, and it's very rare. But it just shows the seriousness with which the federal government views the bonding process. So the Disclosure Council is one of your firewalls. You've got two firewalls essentially. Bond counsel is out there to protect you from the IRS. Your disclosure counsel is out there to protect you from the Securities Exchange Commission or the SEC. Sometimes, in smaller counties, smaller issuances, the underwriter, which is the investment bank, will hire the disclosure counsel to write the document. Now, it saves the county a few bucks if they let the underwriter's attorney write it, because the underwriter is always going to have their attorney on the deal, and they're going to want to get reimbursed. But if you have your own attorney writing the document, the disclosure document, you have somebody you can go to, ask the hard questions, and that represents your interests. So I know attorneys always advocate for having more attorneys in the deal, but in this case, there is a direct benefit to doing so. But the underwriting team, you'll hear a bunch of different names involved in it. And the underwriters are the investment banks. They will agree to essentially buy all of the bonds that you issue, and then they'll turn around and sell them. And essentially, if they don't sell them, they'll be holding whatever they don't sell. On smaller deals, there'll just be one investment bank. If you get into the realm of issuing $100 million worth of bonds in a transaction, you'll see a whole syndicate or 5 or 6 different investment banks involved. So they'll have different roles. The senior managing underwriter would be the one that you're going to deal with, and will essentially you'll have your contract with them, and they'll have their contract with the other underwriters, which we'll call co-underwriters or co-managing underwriters. And then, as mentioned, there's underwriters counsel. The rest of the working group is the trustee. Again, another bank, but their role is to simply, they will have the contract with the issuer of the bonds or the county. And because there could be hundreds of different owners of individual bonds, the bond documents will essentially say, in a default scenario, or if there's a scenario of whether or not something can be done, it'll normally say either a majority of the bondholders have to agree to it, or all of the bondholders have to agree to it. And the trustee is responsible for reading that document and enforcing the rights of the bondholders. Like everybody in the transaction, they'll have their own attorney. And then, depending on the type of deal you can have a consulting engineer if you're doing a utility financing. The consulting engineer will essentially look at your project and make a determination as to the viability of it. And then we'll also, in certain types of deals, have revenue consultants. If any type of a toll road or an airport, in those type deals, you'll have a revenue consultant who's doing the same thing as a consulting engineer. He's looking at the viability of the project. So if you get into a bond deal, you'll hear about a bunch of terms. All of these terms are going to be in the indenture. If you ever have a question about a bond project that's going on, there's 2 places to look in the documents. One is the offering document that the disclosure counsel prepared. The other is the indenture, and the indenture is the document that bond counsel prepared, which is the contract with the trustee and the bondholders. In there, you'll see something about a flow of funds. This is a term that will essentially dictate how the money will flow, the revenue from the project. Normally, it'll say the first revenue in goes out to pay for the project or to refinance the bonds that we brought back, and we're issuing a lower rate interest bond to save money. And then it'll say the next pot of money that comes in we'll use to pay back principal and interest payments. And then sometimes it'll sit there and say the next amount of money that comes in will go to a debt service reserve fund, which I'll talk about in a minute. One of the other covenants you'll see is debt service coverage. A lot of times your bond documents will say you got to have revenues of a certain ratio over your expenditures or your utility stream that's being pledged for the bonds. And what this does is if you get below it, it can trigger other things that happen in the documents, such as a funding of a reserve, or it could be a default. But it gives essentially some comfort to the bondholders that you're in a good financial position. Your rate covenant, you'll see this on a utility deal. Basically, you'll say, well, if you're borrowing money to build a utility, you'll say, we'll promise to keep rates at a high enough rate to pay back our bonds. The additional bonds test is identical to the debt service coverage test, except it's a higher test, and it says before you can issue more bonds, that you're going to use the same revenue stream as security. Before you start getting more money in that's going to impede my security, you need to be making a higher coverage. So more revenues in excess of the pledged stream. Debt Service Reserve Fund, a lot of times it depends on the issuer. Some large counties that go to the markets all the time, they're not expected to, that are in great, A-rated counties, a lot of times they're not expected to have this. Sometimes issuers that are not quite so strong, they'll be required to fund a debt service reserve. And this can be done in a bunch of different ways. One is you can fund the whole thing with bond proceeds, and it could be a year's worth of debt payments. The second is sometimes we fund it with a letter of credit or a surety bond, so that will pay into the reserve if there's a default. And then sometimes it'll ramp up that every so often you'll make an additional payment into the fund till it reaches a certain level of health. Then there's a bunch of other bond covenants that can be there. There's a bunch of positive covenants. You'll keep the project insured. And then there's a whole host of negative covenants. Basically, you won't let everybody use the utility for free. You won't take the pledge funds and put them somewhere else. You won't sell the land that the project's on, and you won't sell the facilities that you finance with the bonds. As you can understand, the lender or the bondholders don't want you to do something else with what they've given you the money for. One thing that's not on the list you'll hear about a lot is redemption features. And basically it'll say there's different types of redemption. Redemption is essentially the bonds get called back. They get paid off early. One is what we call an extraordinary mandatory redemption. And that's a casualty of some sort. Hurricane destroys your utility. You're no longer going to have the money to pay back the payments, so the insurance proceeds will be used to pay off the bonds. The more normal scenario is when can the county call back its bonds? And that's called an optional redemption. If you issued bonds in the mid-1990s and then the rates start coming way down, it's real tempting to go right back to the market and issue the bonds at a lower rate. Well, most bonds will have a 10-year prohibition against you calling back those bonds. Or if you do, you have to pay some sort of premium. This protects the bondholders so that they're not constantly refunding bonds every time the interest rates go down. Normally, after 10 years, issuers are free to call back their bonds. So every year, the bond attorneys, the underwriters are normally the ones that come up with the refundings because they follow the numbers. Or your financial advisor should be doing this and letting you know that these are bonds that we can refund because the rates now in 2013 are significantly less than they were in 2003. The next is the financing timetable, and this is just the bond process is a long process. You can rush them through in a couple of months. They can take a year. They can take an enormously long period of time depending on what you're doing. But essentially there's a decision by the Board of County Commissioners that they want to undertake a new capital project or build something new. Or there's a decision by either them or their staff that, hey, let's go refinance rates. So we either issue new money bonds, as we call them, for new projects, or refunding bonds. Then we get to the point where there's the consultants get involved and they start looking at the financial and feasibility. They'll do an analysis of it. Then the lawyers and the underwriters and the county attorney's staff get involved. The documents start getting drafted. Then we get to the pricing. And I guess one step before this is sometimes you have what we call rated bonds. Most of the county bonds are rated. So you'll go through a process of going up to New York to either Fitch or Moody's or Standard & Poor's, one of the three big rating agencies. They will look at your audited financials, they'll look at the bond documents, and they'll make a determination of the credit worthiness of your county. It has a huge impact on, obviously, your interest rate. Counties that are A-rated or better obviously borrow money a lot cheaper than counties that are trading or have a lower rating. The pricing of the bond, it happens in two different ways, which we'll talk about in a minute, depending on how the bonds are being sold. Then you have a bond resolution, which is normally the Board of County Commissioners okaying the project, okaying the bond financing. And then we have a bond purchase agreement, which is the document that actually sells the bonds, where the county agrees to sell the bonds in a few weeks. Normally it's a 2-week lag. And the underwriter will agree to buy the bonds, provided certain conditions are met and nothing in certain terminating events haven't occurred. Then we have essentially a pre-closing, which is Everybody comes together, all the documents get signed up, and the next day we have the closing, which is the wiring of the funds, and the night before the bonds have been FedExed or sent to a depository. It's almost always DTC is the name of the company, and that's where they will actually hold the physical bonds in a vault. And so when I talked about the pricing earlier, there's two different ways that you sell bonds. One's a competitive, go ahead.
Just a question on the timing. About how long does that normally take to start the day?
From the start of the project, it can depend. If you are doing a refinancing or refunding, a higher interest rate bond with a lower interest rate bond, there's normally not any controversy. So the staff goes, wow, we can save this amount of money if we go ahead and issue this. The Board of County Commissioners normally realize, hey, we're saving money. So the process is a very, very quick process compared to a very a new project, especially one that's very controversial, which is going to require a lot of borrowed money. If you're going to do a general obligation bond, where you have to get voter approval and put it on the ballot and go through that process, we could be talking 2 years. Refundings, I've seen them done in a couple of months, but that's, the average median time could be, I don't know, 6 months, maybe 8 months. That's just a rough guess there. But the competitive, going back to the pricing, the competitive underwriting, these are not quite as common. And what this is the underwriters don't get involved until the day you go to the market. You'll have a financial advisor involved, and this is where the financial advisors do a lot more work. They structure the entire transaction. They go to the market. All the underwriters will submit sealed bids. It's all on computers now. It's really interesting to watch because it's the last one that comes in within a few seconds will inevitably be lower than the one before. So you see who wins it at the last second. And then they give the award to the underwriter or the investment bank that had the lowest total interest cost. Now, these are used in straightforward transactions. If you have well-established credits, if you're a big county, you go to the market all the time. Everybody's seeing your documents. They know what you're refunding. It's easier. Broad investor mix. This means the people buying your bonds are all different types of investors, both institutional investors, mutual funds, even retail investors. Stable bond market, meaning that that the bond market has been not volatile, so that you don't do your bid on the day that the market is going absolutely crazy, and then you get a very bad interest rate. You want to be in a stable bond market where because you pick your day that you're going to the market in advance, you notify everybody that you're having a public competitive underwriting. And then the more common method is the negotiated underwriting. This is when you essentially get the underwriter involved early in the process. They'll be approved by the county at some point to be the underwriter, a lot of times through an RFP process. And they will negotiate the whole transaction with you. The financial advisor is not quite as involved. It's almost a requirement to use it if you're using a very complicated or uncommon transaction or a new type of credit that the market's not familiar with, because your investment bankers can go, well, this is what we're used to seeing here, this is what you need. New or weaker credits a lot of times will be used with. If the bonds are just going to be sold to a limited group of investors, such as if this bond's just going to appeal to a certain type of investor base, retail investors rather than large mutual funds. If the bond market's unpredictable, like I said, you can time it with this. The underwriter can go into the market. If this week's bad, they'll wait until it's good. Or if you need some flexibility. There was a recent study last year by the Securities and Exchange Commission, which saw about a 2% savings to municipalities and counties that went with the competitive underwriting, because obviously the investment banks are all bidding on the project. However, that 2% savings has got to be weighed against the risk of you going into the market on the wrong day or something going wrong. So there's pros and cons to both. This is why you want to have a great financial advisor, can advise you what they think is the best way to go at that time for your particular situation. So how underwriters get paid? Did a real simple number. County borrows $5,000 at 6% interest. For the tax-exempt market, that's actually high. I looked when I came in here, most of them are making 3 to 5% depending on the credits. But the underwriter will buy the bond for a discount in a lot of cases. And in this scenario, they're buying the bonds for 99% of the face value. So you multiply by that by the amount of the bond, and they're going to essentially, if they were to turn around and sell the bonds for their face value, they would make $50 a bond. So then the county's true interest cost is the 6% that they're paying plus that difference in discount. So getting to the process in the Board of County Commissioner Authority, again, this is just kind of another look at the bond process. The staff identifies the financing need, whether or not it's going to be new money or refunding. As counties, you have broad powers to borrow money. You also have a few prohibitions. One is that you can't borrow public money to aid a private entity. Case law has since said, okay, if it's an incidental benefit to a private company, that's not a prohibition. But then the next stage, this is kind of describing the process we talked about a little bit earlier. The Staff or Finance Committee presents the proposal to the Board of County Commissioners. The Board of County Commissioners approves the proposal and the financing team. We adopt the authorizing resolution. It approves the official statement, which is the name of the document we use, the Disclosure Council makes, that describes your transaction and the risk. And the method of sale. Then we have the bond sale, and then eventually we move to the closing. And then I guess going to, the final slide here. Again, going back to the Securities Watchdog, which is the Securities and Exchange Commission. Basically, the federal government, when they first, in response to the Great Depression, is when the Securities and Exchange Commission was created. And when they originally did this, they were worried not about municipal bonds at all. They actually put an express prohibition in that said municipal bonds, county bonds, they do not have to register their bonds with us like the way that a private company would have to do or a publicly traded company would have to do if they wanted to access the capital markets. At that time, there was no fear of collapses, or they were considered very safe investments. And then everything went fine until the early 1970s. New York City gets in major financial trouble. In response to this, there's a move to, everybody starts looking at the municipal markets again, and they realize, okay, it's a little different than it used to be. Now the bonds aren't just owned by huge investment banks. I think the stat now is something around 75 to 80% or 75% of all bonds now are actually owned by individuals. And they're either through your investment funds, your 401k funds, your mutual funds. So the people now at risk of counties defaulting or municipalities defaulting are individual retail investors, not just large institutional lenders. So even though counties have been exempt from the registration requirements of the Securities Exchange Commission, you've never been exempt from the anti-fraud laws. And the anti-fraud laws or what we talked about in that San Diego case where the liability gets involved. But basically it says when you're selling bonds, you can't make a material omission. You can't fail to state something that's material that an investor would want to know that's buying your bonds. And you can't say anything that's materially misleading. Again, this goes back to your disclosure council, why you have attorneys involved in the process. We should be working with your staff to educate them and talking about the particularities of your municipality to determine what needs to be disclosed to the capital markets and the buyers of the bond to avoid liability. And then even though the SEC doesn't have direct authority over you other than the anti-fraud provisions, they've regulated the underwriters of the bonds to the point where now you have to prepare this offering document to go to the capital markets, because the underwriters can't sell the bonds unless they have certain disclosures from you and an agreement from you to make continuing disclosures. So it's becoming a real hot button issue now with the SEC, is that you live up to your continuing disclosure requirements, which are essentially any kind of data, numbers, figures that you use in your offering document. On a yearly basis, you're going to provide them, and there's a website that they actually get put on that you can actually go see all of the documents from your municipality. It's emma.msrb.org, and it allows you to see all, since 2009, and most people provided back documents, but it allows you to see what documents you have out there. Now, on a yearly basis, you're having to file your audited financial statements.
Ryan, can you repeat that?
What was that website again? I'm sorry.
It's EMMA, M as in mom, emma.msrb.org. And it's a website you can play around with, and you can see your debt that your counties have issued. You can see what kind of disclosures you've made. You'll see your audited financial statements on there. Now, this assumes that you've issued bonds, and not all counties have. And what it stands for is the EMMA is called the Electronic
Everybody.
Municipal.
We'll send the website
Can you send the website out? I'm sorry, emma.msrb.org, O-R-G. Well, I'm glad I threw that in there. I could tell some people were listening. They want the federal government to issue legislation that gives them direct authority over municipal issuers, which would create a huge burden on your financing team, and there's costs associated with that. And then second, the other organization out there is the Internal Revenue Service. They are actually, obviously, if they audit your bonds, no one ever wants to be audited. But if you do get audited, you got to get a good bond tax attorney. There is a host of attorneys that literally just specialize in counties and municipalities' tax issues. They actually have a process that they call the VCAP process, which is called the Voluntary Closing Program. And what it does is it allows you to go to them and say, we've got a problem with some of our bonds. We've noticed that we didn't do this the right way. We want to fix it. And what it does is it essentially allows you to fix the problem. And if you don't fix the problem and they find the problem, they'll declare your bonds taxable. That's a huge, huge problem for you going forward and issuing new money. And if you've done some kind of taxable bond, like the Build America bonds, it'll be the end of your revenue payments from the federal government. But the VCAP process allows you to essentially, if you had one small problem, it allows you to fix it and purify your deal. So, and then I guess my last comment is, if you have any questions about what's going on, the answer is always in your documents. Your indenture is the document that is your contract, and will explain what you should and shouldn't be doing. And your disclosure document, if you want to know, normally describes the project itself, what you're using the money for, and what the risks are. Unless we have some questions,
In some of our material, it talked about negotiated sales as opposed to bids. When do you use a negotiated phone?
the negotiated sale is in a scenario where either it's not a traditional credit, or to be honest, most people use them for just to take out the risk of a competitive sale. The competitive sale, you have to notice a couple of weeks in advance. A certain, well, I mean, if you have a competitive sale, you've got 5 to 10 different underwriting firms all coming in to bid on it. So you tend to get a lower price, unless the market's a bad day in the market. So there's a risk there. There's a horrible risk. The other risk is that no one bids on your bonds, and you've gone through this whole process and you realize you had a problem. The negotiated sale, you've been working with one underwriter. Inevitably, you've been working with them for a while. They've helped you structure your transaction. And like I said, the report, in any situation, one could be cheaper than another. The SEC report from a year ago said that the competitive sales were 2% cheaper. But again, that takes out the risk on either way. So.